What if I told you that the warning signs of the next financial crisis didn't come from a small bank, a troubled hedge fund, or a collapsing real estate bubble, but from BlackRock itself? And that the last time a credit market started breaking in this exact way, the global financial system fell apart just 6 months later? Because right now, BlackRock, one of the world's largest and most sophisticated asset managers, has taken a full 100% loss on a private credit loan. A $150 million investment wiped to zero. Most investors would shrug this off. Just one loan. But history tells, do us something very different. Small cracks always appear first. Quietly, far away from the spotlight. And always in the opaque corners of credit markets, where losses hide, models fail, and liquidity disappears without warning. This is the same type of early fracture we saw in 2007, 6 months before the 2008 crash. And if you understand that timeline, you'll understand why BlackRock's loss today is more than a bad bet. It's a signal. The story begins with Renovo Home Partners, a private equity-backed home renovation roll-up that collapsed in bankruptcy. BlackRock, one of its principal lenders, marked its loan down to zero. Not down by half, not discounted, but erased. A 100% loss. That matters, because in the world of private credit, the fastest growing part of modern finance recoveries aren't supposed to fall to zero. Private credit funds pride themselves on being senior lenders, first in line, protected by tight covenants, but here's the twist. Covenants have been evaporating for years. More than 80% of the private credit market is now covenant-lite, a polite way of saying, we don't have enough protections if things go wrong. When BlackRock, a firm famous for its risk management system, Aladdin takes a total loss. It tells you something. The assumptions built into the entire market may be wrong. And this is exactly what happened before. To see the danger of a first loss, we need to travel back to 2007, before Lehman Brothers collapsed, before the housing market imploded, before the world realized the financial system was sitting on a powder keg. In February 2007, two little-known Bear Stearns hedge funds began showing unexpected stress. They were stuffed with subprime mortgage bonds, supposedly diversified, supposedly safe. Then in June, those same funds collapsed completely, just as Renovo has now. Back then, Wall Street told everyone the same thing you're hearing today. It's isolated. It's contained. Just one bad book. But people like Larry Fink, BlackRock's CEO, were not fooled. As early as mid-2007, Fink publicly warned that the structured credit market had fundamental problems. Opacity, mispriced risk, assets nobody could value, models relying on assumptions that were breaking apart. He wasn't dramatic. He wasn't emotional. He simply pointed out the truth. When liquidity disappears, valuation becomes impossible. And by March 2008, 6 months before Lehman fell, Bear Stearns collapsed. BlackRock was brought in by the Federal Reserve to evaluate Bear's toxic assets because almost nobody else could figure out what they were worth. BlackRock's internal assessment was simple. There was no liquidity, there was no functioning market, and the worst was still ahead. That was the warning sign. 6 months later, Lehman Brothers was gone. 6 months after that, global markets crashed. The pattern is undeniable. When assets become impossible to value, when recoveries fall towards zero, when opaque corners of credit start breaking, systemic risk is already underway. And today, that's happening in private credit. To understand why this matters so much, you need to look at what private credit has become. After 2008, regulators tightened the rules on banks. Lending moved off bank balance sheets and into private funds, shadow banking too. These funds exploded from under $300 billion in 2010 to more than $1.5 trillion today. No public pricing, no daily liquidity, no standardized reporting, no mandatory ratings. Loans are not traded. They're marked to model, not marked to market. This is exactly where hidden risk thrives. The private credit boom was built on one assumption. Companies can always refinance. But in 2024, borrowing costs didn't just rise, they doubled, tripled, even quadrupled from 2021 levels. Many private equity-backed companies can barely pay their interest anymore. More than 1/5 of the Russell 2000 are zombie companies. They survive only by refinancing. If refinancing closes, they die. And when they die, private credit lenders take losses, sometimes big ones, sometimes 100% ones. That's why BlackRock's loss matters. Because if the largest asset manager in the world can take a complete wipeout on a supposedly senior loan, then the assumptions underlying trillions of dollars of private credit need to be questioned. But the deeper parallel to 2008 is not the loss itself, it's the pattern. Look at the 2007 timeline. First, small stress in structured credit. Then, individual blowups. Then, Bear Stearns collapsed. Then, banks suffered write-downs. Then, liquidity froze. Then the crisis hit. And now look at 2024. First, stress in leveraged loans and lower-tier borrowers. Then, bankruptcies of highly leveraged, private equity-backed companies. Then a 100% loss for a mega manager like BlackRock, default rates rising, recoveries falling, liquidity thinning in private markets. A $2 trillion refinancing wall approaching in 2025-26. The mechanics are eerily similar. In 2007, the risk was hidden in subprime securities. In 2024, the risk is hidden in private loans. In 2007, financial institutions relied on models that failed to capture real-world stress. In 2024, private credit valuations rely on internal marks and theoretical models. In 2007, the first losses were dismissed as isolated. In 2024, BlackRock's loss is being described the exact same way. History doesn't repeat perfectly, but the rhyme is loud. One of the most important but overlooked links between the two eras is liquidity, the lifeblood of markets. In 2007, liquidity quietly evaporated from structured credit markets long before the public realized what was happening. Prices looked stable until nobody wanted to buy anything. That's when bonds marked at 95 suddenly had no bids, not even at 50 or 30 or 10. The same dynamic exists in private credit today. These loans rarely trade. Funds allow redemptions only quarterly or semi-annually. If redemptions spike, fund managers can freeze withdrawals. If companies can't refinance, defaults surge. And when defaults surge, valuations plunge. This is a market engineered for stability in good times and fragility in bad times. That's why BlackRock's write-down matters. It's a real-world mark-to-market event in a corner of finance where marks are usually theoretical. And whenever theoretical models collide with real losses, the illusion breaks. So, what is the warning? And why is it similar to the one before 2008? It's simple. Early losses in opaque credit markets reveal that liquidity assumptions are breaking down. In 2007, it was subprime. In 2024, it's private credit. In 2007, it began with seemingly isolated failures. In 2024, it's starting the same way. In 2007, policymakers underestimated the contagion. In 2024, we see similar confidence that private credit is diversified and stable. But here's the truth. When an entire market is built on refinancing, and refinancing becomes impossible, the dominoes fall fast. The most dangerous part of this story is timing. In 2007, Bear Stearns fell in March. Lehman fell in September. 6 months. Not years. Months. Today, private credit is showing strain just as America faces a $2 trillion refinancing wall over the next 2 years. Companies that borrowed at 5% are now refinancing at 9% or more. Those economics don't work. And when economics stop working, losses follow. Sometimes quietly, sometimes loudly, but always inevitably. BlackRock, ironically, is both a participant and a historian in this story. In 2008, they were called in to clean up the mess, valuing toxic assets for the government, helping stabilize markets, earning billions in contracts. Their risk models were praised for surviving the storm. Today, they're taking their first major public loss in private credit, an early crack that mirrors the early cracks of 2007. But here's the most fascinating twist. BlackRock's own leadership today is sounding cautious again. Larry Fink has warned that private markets may be overvalued. Rick Rieder has suggested rates should fall toward 3%, a sign that credit stress is building. BlackRock's research has highlighted risks in private credit even as the market explodes in size. They are not predicting a crash, but they are, once again, positioning carefully. That's the kind of warning sign people missed last time. So where does this leave us? Not in panic, but in recognition. Financial history is full of patterns. Not identical events, but recurring themes. Hidden leverage, illiquidity, overconfidence, the belief that this time is different. Small, early fractures that later prove to be the first sign of a much larger break. BlackRock's 100% loss is not the crisis. It is not the collapse. It is not the end. But it might be the beginning of the beginning. The first data point in a pattern we've seen before. A warning that the private credit boom, a market larger than subprime at its peak, may not be as invincible as people think. A reminder that when credit markets break, they break quietly. Then all at once. In 2007, the first cracks appeared 6 months before the crash. In 2024, the cracks are appearing again. And history shows that ignoring the first cracks is always the biggest mistake. But to understand just how serious this moment is, we need to go deeper beyond BlackRock, beyond Renovo, beyond private credit itself. Because history shows us something far more important. Crises never start where the spotlight is shining. They start where the shadows are darkest. In 2007, the world watched Wall Street. But the real story was happening inside obscure mortgage structures, special investment vehicles, and off-balance sheet debt. Most investors didn't even know those things existed. Today, the same blindness exists in private credit. Investors see the headlines about stocks. They debate the Fed. They focus on inflation and unemployment. But hidden behind all of it, a $1.7 trillion market is quietly absorbing losses that nobody can see until it's too late. And the most important truth of all? Crises don't start with the big players. They end with them. They start with the early casualties, the exact kind of 100% loss BlackRock just took. Picture this. December 2006. Goldman Sachs quietly begins cutting its exposure to subprime. February 2007. Two Bear Stearns funds report unexpected stress. June 2007. They collapse completely. August 2007. French bank BNP Paribas freezes withdrawals on funds with subprime exposure, saying, "A complete evaporation of liquidity." Nobody listened. Markets stayed calm. The S&P 500 reached new highs. Fast forward 6 months. Bear Stearns collapses. 6 months after that, Lehman goes bankrupt. Banks fail. Unemployment spikes. The housing market implodes. The warning signs were small, invisible, technical, but they were accurate. Today, we are once again surrounded by technical warnings, small events that don't make headlines, declining recovery rates in private credit, companies defaulting faster than expected, interest coverage ratios collapsing, redemptions rising in certain private funds, money markets and insurers increasing exposure to short-term private credit. These are the same kinds of fractures that appeared before 2008. Economists often miss the first signs of crisis because they focus on the wrong data. They watch GDP. They study jobs reports. They track inflation. But credit markets collapse in a much quieter way. They fail through maturity walls, liquidity mismatches, and valuation illusions. Let's break those down simply. 1. Maturity wall. This is the moment when trillions in debt must be refinanced. From 2025 to 2026, U.S. companies face more than $1.5 trillion in maturing loans and bonds. If refinancing becomes expensive or impossible, defaults rise fast. 2. Liquidity mismatch. Private credit funds promise steady yields, low volatility, and periodic withdrawals. But the loans are illiquid, many cannot be sold quickly. If too many people ask for redemptions at once, funds can freeze withdrawals. This already happened in the UK property market in 2016 and 2019. 3. Valuation illusion. Because private credit assets don't trade frequently, they are priced by models, not the market. Models work in calm times, but in stress, they fail instantly. This is the exact issue Larry Fink warned about in 2007. It's the same issue BlackRock is facing now. Imagine a vast network of private equity-backed companies, restaurants, gyms, manufacturers, home renovation, companies, software firms, trucking businesses. Most of them took on debt in 2000 and 2021, when interest rates were near zero. Fast forward to 2024. They now face borrowing costs of 8% to 11%. Their cash flows haven't grown. Their debt has. This gap is the oxygen tank running out. When one company collapses like Renovo, it is not a random failure. It is the first proof that the system is under strain. Just like the Bear Stearns funds were the first proof in 2007. Let's be clear. BlackRock is not a reckless lender. They have the best risk models in the world. They advise governments. Their Aladdin system is used to manage over $21 trillion in global assets. For a firm this sophisticated to take a 100% loss, several things must be true. Collateral was weak. Leverage was high. Liquidity was thin. The market structure itself is fragile. That's why this loss is not just one investment. It's a signal. Because BlackRock rarely marks anything to zero unless it has no choice. And when the biggest player in the room takes a hit, it means smaller players are already getting crushed, silently. Let's compare the timelines. 2007, timeline. February. Early fund losses. June. Collapse of subprime funds. August. Liquidity freeze. March 2008. Bear Stearns collapses. September 2008. Lehman collapses. 2024. Timeline. Q1, Q2, 2024. Rising leveraged loan defaults. June 2024. Renovo bankruptcy. BlackRock. Writes loan down to zero. 2024-25. Liquidity stress growing. 2025-26. Massive refinancing wall approaching. The resemblance is uncomfortable. Both eras share the same sequence. Early, small losses. Liquidity stress. Valuation problems. Confidence erosion. Systemic risk. That is how credit crises unfold. Here is the twist. In 2008, the crisis was largely contained to banks. Banks were regulated. Banks could be bailed out. But today, much of the risk sits in private markets, where lenders are not regulated like banks. Borrowers have fewer obligations. Transparency is minimal. Leverage is hidden. Liquidity is weak. And private credit has quietly grown bigger than the subprime mortgage market in 2007. If this market cracks, policymakers may not have the tools to contain it. That's why BlackRock's loss isn't a headline, it's a pressure leak. Financial historians from Reinhardt and Rogoff to Kindleberger document a single recurring truth. Credit booms end the same way. Not suddenly, but slowly, then all at once. The slow part is happening now. Rising defaults, early losses, liquidity thinning, leverage concealed, investors complacent. The all-at-once part begins when a major borrower, fund, or sector fails unexpectedly. In 2008, that moment was Lehman Brothers. In 2024-25, we don't know who it will be. It could be a private credit giant, a private equity portfolio, a refinancing failure, a large corporate bankruptcy, a wave of redemptions. History doesn't repeat, but the script is familiar. So what do we learn from all of this? Not that the world is ending, not that a crash is guaranteed, but that the financial system is giving us the same signals it gave last time: early losses and opaque credit, liquidity fading at the edges, valuations not matching reality, borrowers struggling under higher rates, investors assuming everything is fine. The same ingredients, the same complacency, the same pattern. BlackRock's 100% loss is not the explosion. It is the flicker before the smoke, the tremor before the earthquake, the whisper before the storm. And history tells us one thing with absolute clarity: ignoring the early warnings is always the most expensive mistake. Because here's the truth most people never learn until it's too late. Financial crises don't arrive with breaking news alerts. They arrive with whispers, with quiet signals, with numbers hidden deep inside corporate filings, with small bankruptcies that barely make the news, with losses so isolated the world doesn't pay attention. In 2007, the whispers began with 2 hedge funds. In 2008, they became a scream. In 2024, the whispers are starting again. And this time, they're coming from the very institution that helped diagnose the last crisis. BlackRock isn't sounding an alarm by choice. The markets are doing it for them. A 100% loss on a private credit loan is not a freak event. It's a crack in the foundation. It's a moment where the market tells the truth, even when everyone else is still believing the illusion. And here's the most important thing, too. Understand, history punishes those who ignore its patterns and rewards those who pay attention to its warnings. Imagine you're standing in a massive library, 1,000 years of financial history and books stacked floor to ceiling. Every crisis, tulip mania, the South Sea bubble, 1,929, 1,987, 2,000, 2008. Each one begins with the same sequence: a boom, a story, a period of calm, a belief that this time is different. Then the early crack, the one nobody pays attention to, the one historians write about later and say, that was the moment everything began to unravel. In 2007, it was Bear Stearns' hedge funds. In 2024, it might very well be BlackRock's 100% private credit loss, not because the loss itself is huge, but because the loss reveals something bigger. The system behind it is far more fragile than anyone wants to admit. We are not predicting a crash. We are not forecasting doom. We are doing something far more important. We are remembering. We are looking at history not as a warning from the past, but as a map for the future. And history's message is simple: cracks become crises only when we choose to ignore them. And today, the cracks are showing. If you found this breakdown valuable, if you want more historical deep dives like this, and if you believe financial knowledge is your best defense in an uncertain world, then subscribe, drop a comment, and and share this video with someone who still thinks everything is fine. Because understanding these early warning signs doesn't just help you avoid losses, it helps you see what others miss. And in finance, seeing what others miss is the closest thing to a superpower you can have. In 2007, the warning came 6 months before. Disaster. In 2024, the warning might be here again. The question is, will we listen this time?